Hi. So we are going to start. Hi everyone. My name is Amit Maheshwari. I'm the managing partner of AKM Global. I'm sorry I'm having issues with my video. I'm trying to fix it. But in the interest of time, we would like to start right away. Thank you. Good morning and good evening to you, to all of you who have joined us on this panel and this discussion on the Union Budget 2026. Uh, AKM Global, as many of you know, is a premier tax consulting firm in India and in UAE. We are around 700 people, and we all what we do is cross-border tax consulting, advisory, and virtual CFO services. Very glad to be hosting this webinar. So this union budget, which came in on 1st of February, has come in the backdrop of significant global uncertainty marked by geopolitical tensions, shifting supply chains, and deglobalization. So, our Honorable Finance Minister, Srimati Nirmala Sitharaman, did a very fine job of keeping these in mind and providing an excellent budget. While India has demonstrated resilience in the face of global uncertainty, we are now focused on laying the foundation for the next 2 decades of growth, innovation, and national transformation. So, in this background, this budget presented by our Honorable Finance Minister assumes particular significance. So, the Finance Minister has described this year's budget as a Yuva Shakti driven budget, placing India's youth at the center of nation's development strategy. And as you know, we have a very young population, and it's imperative for the government to think about the youngsters who are the future of this great country. So, at its core, this budget reflects the government's stated sankalp to ensure the economic growth remains inclusive while the broader reform momentum continues on a stable and a credible path. And the finance minister also reaffirmed the government's commitment to the poor, underprivileged, and the disadvantaged. So while we are going ahead, we are not forgetting those who are left behind. And this policy narrative is structured around three core kartavyas, and those are accelerating economic growth, building human capacity, and ensuring inclusive development. And this is very much aligned with the broader vision of Sabka Saath, Sabka Vikas, which has been a core guiding principle for the current government. So what clearly stands out in the government emphasis on long-term institution building, and there's a continued focus on sustaining structural reforms, strengthening the financial system, and increasingly what we have seen leveraging technology and data to improve governance outcomes. So our digital stack and our technology and data has been the backbone and has earned global appreciation, and it is something which we have also exported to the world. So, by prioritizing infrastructure, manufacturing, green innovation, and MSME development, this budget actually strengthens India foundation for long-term economic momentum. And what we are going to discuss today are the tax proposals. And from a taxation standpoint, there is a conscious and welcome attempt to make the tax system very simple and more predictable for taxpayers. And while at the same time pushing strongly for ease of compliance through digital enablement and data driven oversight rather than through intrusive or discretionary intervention. That's very important. So a lot of things now have become more predictive, data oriented, with less and less intervention from the government. So that's something which we are very proud of, and the government has done a very credible job in doing that. And obviously, in every budget, they are only enhancing it. One very important thing which the budget has done is decriminalization and ease of doing business by removing criminal provisions for very minor and technical defaults. So that's something which is very welcome. I mean, long gone are the days where taxpayers were unnecessarily harassed for very small, petty defaults, which were completely due to oversight and not due to any misconduct or any intention to evade taxes. So for businesses, certainly this is a pivotal time to align strategies with new emerging opportunities across sectors, and that has been a key theme of this budget. So with this context, I mean the proposals in the budget are not standalone announcements. So we are going to only do tax, but these are not standalone announcements, but they are part of a broader reform journey which India has undertaken to become a developed nation by 2047, which is called the Viksit Bharat 2047 mission. So with this backdrop, I'm going to hand it over to my colleagues who would be deliberating on the key tax provisions in this union budget, uh, talking about from the taxpayer's point of view, and in some cases also going to discuss about the economy and businesses at large. Uh, I wanted to introduce my colleagues today who will be deliberating. I have Sandeep Sehgal, who is a partner in a tax and regulatory practice, Manish Garg, who is partner of transfer pricing and tax litigation, Ikesh Nagpal, head of our indirect taxes, and Vikas Sharma, our colleague from the transactional advisory division. So I will let my colleagues deliberate further. Thank you for the time, and I'm really sorry for my video. It's not up and running due to some fault. Thanks a lot. Over to you, Sandeep, for starting the discussions. Thanks everyone for joining in.
Sure, sure. Thank you, Amit, so much. Very welcome to all the August audience, which has actually taken the time to attend this particular webinar. So, I mean, as Amit has mentioned, that there are several pillars to this union budget, and what we see is that there is some clear direction to so many initiatives which have been taken. Which even if you talk about technology or let's say uh, making the life easier for taxpayer to any initiatives like for example the filing of LDC online or similar other things. So obviously we would be talking about all those proposals during this presentation. Sorry. So Gaurav, can you move on to the next slide? Yeah, sure. So, so first, I would be dealing with the corporate tax proposals which have been brought in this union budget. Then my other colleagues would be taking the respective parts. So, the first important amendment which relates to the exemption for foreign companies for data center. So, as we have seen in the past, for example, in the last year as well, the Indian government brought a presented tax regime for foreign companies who would provide some kind of technology support and other kind of support for electronic manufacturing facilities in India. So, so I mean that was not an exemption, but that was basically presented scheme where the profits would be taxed at 25%. I mean the profits would be deemed at 25%. Effective tax rate would turn out to be like somewhere around 10%. So I think this is a very big, but this one is actually a very bigger initiative where they have actually given exemption for till 31st March 2047 to the foreign companies who would be helping the Indian companies in providing the data center services. However, the one of the condition is that if they need to provide these services to the Indian customers, they would mandatorily need to appoint a reseller in India. So, as we see, the idea seems to be that uh, the lot of Indian startups or the Indian companies who are in the technology space, they would be able to take the advantage of these new data centers that would get developed in this initiative. And obviously, the government would be notifying who all of the data centers who would be eligible for these exemptions. So this will serve a twin purpose. I mean, the the companies in India would get the benefit of these data center which are local in India, and the other thing is that the other thing is other aspect relates to the data security where the data will stay in India. So I think this will definitely incentivize the foreign companies to look at this proposal seriously. I mean, and in some way it would also help in transferring some kind of knowledge transfer to the Indian companies in maybe in the terms of best practices or the latest tech available for setting up these data centers. However, the concern on this part remain is that what would happen? I mean, the India obviously the India would be exempting these profits till 31st March 47, but what would happen under the Pillar 2 regime? Obviously, India hasn't implemented yet, but if we talk about from the company's perspective and where their respective jurisdiction may have already introduced some provisions with respect to Pillar 2, since they are required to pay at least minimum 50% tax on their global profits. So they would need to take into these kind of calculations in consideration while doing this exercise and finally deciding on setting up in India. The other important amendment, I mean, which is also much talked about, is the taxation on buyback. So as we know, before 2024, this buyback was treated as a capital gains in the hands of the taxpayers. Then in 2024, the regime was changed where the buyback was taxed as dividends, and then the shares which got extinguished would generate a capital loss for the investor or the shareholders. However, what we have seen is that, I mean, in the past during this particular period, in the past couple of years, there have been some buybacks where the retail investor as such may not have shown much enthusiasm as such. And I believe some private companies also have taken advantage of these provisions where they have been resorted to buyback taxation because it may have uh, proved to be tax efficient in some other manner for them. So I think the government has realized that maybe the earlier regime was better because it provided greater flexibility to the investors at their hand. And that's why I think they have kind of taken a U-turn and resorted to the old regime where it would be taxed as capital gains only. However, the government is wary of the fact that the promoters can still use it as a tool for tax planning. So, uh, so that's why they have introduced some kind of deterrent in the sense that at least the promoters would be subject to a higher taxation, so that if the promoter is a domestic company, it is anyway subject to an effective tax rate of 22% at least. And if it is any other investor other than domestic company, they would be subject to tax at 30%. However, the investors or the shareholders who are not promoters or who are retail investors, they would still be subject to capital gains tax as per the normal provisions, where the short-term gains would be 20% and the long-term capital gains tax would be 12.5%. So the idea seems to be that the buyback is a tool which should be used only for only the consultation should only be commercial or from corporate governance practice, and the promoter should not use this tool for their own tax planning. So we can move on to the next slide. And in the meantime, I just wanted to reiterate that, I mean, we would be happy to take any questions on any aspect that you have any query. So you can put your questions in the in Q&A. So, if possible, we would be answering some of these questions live, or we would be answering these questions in the chat as well. So the another important amendment relates to the updated return. So I think this is something which would be I would say would is kind of another benefit to the taxpayers who may have some kind of an omission in their tax returns, and which may result in some kind of an additional tax liability. Uh, so as we know that updated return can be filed till the end of 4 years, and you will need to pay a higher amount apart for the tax liability depending on the year in which you file this particular return. However, the scope of this updated return has been extended in the sense that so let's say there is a taxpayer who doesn't have any kind of additional tax liability, but they may have claimed an excess loss while filing their tax return. So there was a representation that at least those taxpayers should also be allowed an opportunity under the updated return regime, where they could at least, if they want to reduce their tax losses, they could do that so that they do not get challenged at the time of reassessment or reassessment, and could be subject to any kind of penal actions going forward during those proceedings. So I think this is another welcome step. And the other important leeway which has been allowed is that even if there is an assessment or a reassessment going on in case of a particular taxpayer, they can still avail this facility. So they can file an updated return voluntarily and declare any kind of additional tax liability that they want to do. And that ways, I mean, that would serve. So that would save a lot of time and effort both on the part of taxpayer as well as the income tax department. However, there is a caveat that if in such cases the taxpayer utilizes the facility of updated return, particularly when they have already got an reassessment or reassessment notice or the proceedings are underway, they are required to pay 10% more than what is actually provided in the erstwhile scheme. But I think this is again, I would say, this is something which is still kind of a win-win for both the parties. And I'm sure that many taxpayers would like to avail this facility going forward. The another important amendment I would say relates to the employee contribution for PF. So I think, as Amit mentioned in the beginning, that the government in this particular budget has taken the uh, uh, and and the thing is that we also need to keep in mind that the from the next financial year, that is beginning from 1st April 26, we would be transitioning to the new Income Tax Act 2025. And the government also don't want to carry over much of the issues which have been kind of been litigated in the past in the earlier Income Tax Act 1961. So I think this is another important amendment to clear the air on one of the burning issues, and they have been always been different diverse views as to what will happen to the employee, because in case of an employer contribution which is subject to a disallowance under 43B, but there you have the leeway that you can still pay your liability before the filing of your tax return and can still avail the same. However, on the employee contribution, there was no clear direction as such, and unfortunately, we had a Supreme Court ruling in 2022 in the matter of checkmate services, where the Supreme Court said that the employee contribution and employer contribution cannot be kept on equal footing. So, and recently, there has been other matter which has reached to Supreme Court again in the matter of Woodland Aero Club, where the same question is again in the front of the Supreme Court, which it will be examining it in the due course. But at least the government has ensured that this doesn't remain an issue with the new Income Tax Act. So at least they have amended the relevant provisions in the Income Tax Act 2025. So going forward from any tax year from financial year 26-27, you would not have this controversy, and the employee contribution, employer contribution would have equal treatment. So which means if there is a delay in the payment of employee contribution of PF or ESI or any kind of employee welfare, you can still claim the same if you pay the same before the filing of your tax return. So I mean, you would not. So if you may miss the deadline as per the relevant statutory provisions of the labor laws. So the taxpayers in those cases would not be jeopardized, and they would still be able to claim it. So again, this is a welcome amendment, I would say. So we can move on to the next slide. The other amendment relates to the amendment in the rates of the securities transaction tax. Uh, I mean, as we have been hearing in the past from SEBI and several other authorities, that retail investors do lose money on options in future trading. And I think the government is trying to keep those retail investors away, and increasing the security transaction tax is one of the tool which was available to the government, and I think they have used it in this particular year. And as we have seen after COVID, I mean, the rates have been revised maybe a couple of times. I think first in 2023, then again in 24, and now in 26. So, I mean, if you see it from 2019 onwards, the STT rates on future trade have gone up by almost like 5x, and in case of option trading, these may have gone up by 3x. So, I mean, the government anticipates, or at least the SEBI anticipates that this would provide enough deterrence to the retail investors to stay away from this. But I mean, the time will tell that how this pans out, and how much effect this would have going forward in the behavior of the investors. The another important amendment relates to the crypto reporting on the crypto exchanges or the crypto intermediaries. So there was a provision where they were required to do some kind of reporting annually or periodically, which was similar to SFT. Uh, However, there was no specific penalty for non-compliance of this particular filing. So in this particular, in this budget, they have introduced a penalty going forward from 1st April 26, so that if any exchange does not do these requisite filings which are asked for by the government in the requisite forms and then within the requisite time period, the exchanges would be subject to a penalty of 200 rupees per day until the date of default, and an additional penalty of 50,000 rupees for providing any kind of inaccurate information. And the government has also laid down certain norms for due diligence, or you can say KYC norms for the customers that they onboard. And if the government finds that there is uh, I mean, the information available are not accurate, or the KYC norms have not been followed as diligently as expected. So the exchanges could be subject to a penalty of 50,000 rupees. So we can move on to the next slide. So yes, so this is another important amendment related to, I mean, I would say clarification on TDS on supply of manpower. So there have been controversies in the past whether the supply of manpower is I mean, it's whether it's a contractual arrangement or it is kind of a professional service. And we have seen some litigations in the past on this particular issue. So, I mean, this time the government has made it clear that this would form part of the works contract and hence would be subject to TDS at the rate of 1% or 2%, as the case may be under the provisions of 194C under the older income tax act, and the whatever and the corresponding provisions under the income tax act 2025. Uh, the other important amendment relates to the deductions on dividend income. So, I mean, there have been some amendments in the past on dividends that uh, at least the dividend that you get from equity or let's say or any other apart from mutual funds like any other securities, no deduction for any expense, be it interest or any other expense is allowed. From this year, I think they have extended it to the dividends received from mutual funds and certain other funds under the older scheme of UTI, wherein they have clarified that this 20% deduction of the interest which was hitherto available would no longer be available. So effectively, as we approach 1st April 2026, so if there is any dividend income from any kind of securities, be it mutual funds or equity shares, the taxpayers would not be able to get any kind of deduction from those incomes, be it interest or any other kind of brokerage or any other similar expense. The another important amendment. So this is not a tax amendment. This is an amendment which has been brought under the provisions of FEMA. But we thought that this is also which is kind of significant, so we should deal with the same as well. So the portfolio investment scheme for the non-resident investors can be liberalized. So then under the old scheme, they were eligible to invest up to 5% in a particular company under this PIS scheme. And let's say if they wanted to invest for a higher amount, they would have to move to maybe an FPI route, or maybe approach or maybe invest through some another FPI. So now the limit has been increased from 5% to 10%, uh, which actually reduces a lot of hassles for these kind of investors. Most of these would be individuals. I mean, some of them may have access to uh, uh, good advisors, maybe legal or tax, but still, I think there was still a room for liberalizing it further, which the government has done in this particular year. And I think this is a welcome amendment, which will make the life easy for so many overseas investors who are looking to tap into the Indian markets. And this, I would say, would could may I would say may increase some kind of inflow from the overseas countries, especially NRIs sitting in those locations. Although the amount may not be very significant, but still, I think it would have some, I would say, some reasonable impact on the overall inflows that we see in the Indian equity markets. And the another important amendment says that when it is kind of a, so if you allow 10% for a particular investor, there could be multiple investors. So earlier there was a limit of 10% for all PR Y persons. Now this limit has been increased to 24% so that you can onboard multiple investors who want to tap into this particular regime. So we can move on to the next slide. Yeah. So these are so I mean every year, I mean this has been the trend that the government is pushing for the Give City on a very aggressive basis, and they are very serious that they want to attract many offshore funds, or at least want to encourage at least the Indian funds who move overseas for the overseas investments, so that they want that everybody would set up their off shops in Give City or the IFSC. So this year as well, considering that we have new income tax act going forward, so they have brought some amendments in the new income tax act, wherein they have said that the exemption with respect to the profits, which was earlier 10 consecutive years for IFSC. I mean, IFSC for IFSC it was 10 consecutive years within any first 15 years which they can choose. But for the OBUs, it was 10 first consecutive years. So now they have increased this limit of 10 years to 20 years. So now the OBUs would be able to get this tax benefit in the first 20 years when they set up in this particular structure. And for the IFSC units, basically for treasury operations or any other operations, they would be able to get this exemption for any 20 consecutive years during the first 25 years of their setup in GIFT City. Uh, However, in cases, I mean, there has been a caveat which has been introduced now that any unit which has been set up after 1st April 2026, I mean, it has to be a new unit so that, I mean, somebody may not just reorganize the operations and form another entity to take this incentive. So, which means that the older units which are already there, uh, they uh, they would not be able to tap it beyond the stipulated tab lines. But at least for the new units which come up, they would be able to get this benefit. So as I said, I mean this will definitely serve as a good catalyst, coupled with earlier measures which have been introduced in the past several years. And I think the investors will also closely look into these benefits which are being introduced from year to year. And I think this would give the impression that the government is open to listen and provide any other benefits that the community would ask for. If this is something which is within the confines of the government or the IFSC authorities or any other government authority, so to say. Uh, the another important amendment relates to the intra-group loans or the treasury operations which are set up in IFSC, because generally they would be doing all these intra-company loans between the other group entities which could be situated overseas. So earlier, I mean, there were some definitions which were not provided or were not notified. Now these have been incorporated in the new income tax act, that what would be the definition of group entity or parent or principal. So this would provide clarity, and now they have, but they have actually made the intention clear that they want to do this only for the bona fide operation, so that if any IFSO treasury operation is transacting with any other offshore unit of theirs located overseas, that other unit should be sitting in a notified jurisdiction, which means which could be unit which could be FATF compliant or any other similar qualification. So the another amendment relates to the relaxation of the specified fund condition and OBU investment eligibility, where these IFSC units were required to comply with this 5% investor limit, so that one investor cannot hold more than 5%. And it was measured both in the number of units and the value of units. Now they have actually relaxed it to only to the number of units, and they would not necessarily looking at the value of unit. So that would provide greater flexibility to these funds to structure their cap table or their investor base. Uh, and as I mentioned that there was a kind of a sunset for OBU unit which was set up till 31st March 2025. So now they have extended this to or any OBU units which are able to set up their units by 31st March 2020. So I mean all these measures which relate to Gift City, I think would provide uh, more impetus to the parties which are already working there and those who are actually evaluating to enter into the gift city. Uh, so after this, I would pass this on to my colleague Vikas Sharma, who would be looking into the deliberating into the personal tax proposals. So Vikas, over to you.
Yeah, thank you so much, Sandeep, for putting your greater insight on corporate tax proposals aspect covering buyback and the data centers, updated return, and likewise. So before we move forward for the personal tax proposal, which our Honorable Finance Minister has into her kitty. So just to apprise, there are no slab rate changes for this year since she had already made in last year, and so everybody anticipate that okay, there shall not be any changes, and she stick to that. So all in all, there is no changes in the slab rate, and they are moving more towards the new tax regime, and there are no such proposals for the old tax regime. So it can be inferred that government is more on the path to bring new tax regime to be more lucrative for the taxpayer. So yes, let's move forward for the personal tax proposals for this year. Likewise, they have implemented very good changes. They have proposed very good changes, that relief on motor accident compensation claim. There were earlier a controversy regarding the amount received as a compensation. The courts, several courts has viewed that the amount received should be treated as a capital receipt. Thus, the all in all that the taxpayer would say that okay, since this is a capital receipt, so that shall not be taxable. So the tax authorities have shifted the discussion toward the interest element. Earlier, so there has been resultant victims, those who have suffered because of that. That okay, interest compensation due to motor accident claim would be deemed taxable. So what happens earlier is, let's suppose if any of the victim is his or her income interest income is or let's say all any other income below the threshold, so they would supposed to file a tax return, would need to claim a tax refund, and all the jazz happen. So just to curb that, this is a very welcome move by the honorable finance minister, that they outrightly provided that okay, if anybody would receive interest income due to that motor accident, so the entire income would be not to be taxable, and there is no TDS and there is no withholding. So I believe it provide a a very practical relief and easier access to full compensation that would help them in the tough time. Again, very welcome move for the removal of tenant requirement. What earlier in the existing framework, if you sell any property to the resident under 194 IA of the Erstwhile Act, there is no requirement to obtain a tenant if you sell out the property to the resident. So the transaction between the residents. So it is very easier that okay, resident tax the resident person can without 10 they can file their TDS requirements, withholding, and so on and so forth. So it has been proposed, so what has been observed, when they transact through the non-resident and when they purchase from non-resident, so it has been observed that in such cases there is a requirement to obtain a TAN number, which cause unnecessary hassles to them. So again, it is a very good move by the Honorable Finance Minister. It has been now been proposed that such resident individual shall not be required to obtain a TAN, and the resident buyer shall deduct and deposit through PAN-based mechanism. Obviously, we will see what in the income tax rules would say that how this mechanism would work in the in the near future. As an important aspect, I could say that okay, this could be very it could simplify the procedure compliance for one-time property transaction, and it could also promote a ease of compliance for such residents, while the obligation to deduct tax at source continues to remain unchanged. Again, they have rationalized the obtaining of the lower withholding tax certificate. So earlier, what happens is, if let's suppose any applications for certifications for reduction of tax at lower or nil rate were verified manually by the assessing officer, which often result in unwanted, inordinate delays for the you can say small taxpayers to obtain the lower withholding tax from the tax authorities. So thus, it is a need of our to reduce such hassles, and we would appreciate the welcome move by the Honorable Finance Minister that they have rationalized these provisions to obtain LDC in a electronic verification mode. But the catch point here is they would yet to define what small taxpayer is. Again, as I just mentioned, let's look into the what income tax rules say, and we believe that they would be notified in the times to come. Next slide, please. Again, a rationalized amendment that they have enabled filing of declaration for no deduction to a repository. So under the existing framework, taxpayers seeking non-reduction of TDS on dividend, interest on securities, on specified securities or unit, they have to furnish Form 15G and 15H to each person responsible for paying such sum. So, again, it causes unnecessary hassles to them, multiple declaration pass on to the multiple, you can say, deductors, causing nuances to the common taxpayer. So again, to simplify compliance for investor, it has been proposed that, okay, such a declaration shall be furnished electronically to the depository rather than to the each deductor, and depository may do own arrangement, they will available to the respective payer. Further, it is very good point that for the ease of compliance, they have been shifted the reporting requirement from monthly to the quarterly basis. But the point is, this could only available where specified securities are held in dematerialized form listed on the recognized stock exchange. So again, it reduces duplication for compliances for investor and rationalizes reporting obligations for the payers. Then the third point is the exemption. They have proposed a good point for the sovereign gold bond. So earlier, the government stated, you can say the objective is to ensure uniformity application of the exemption, and they intend to restrict our tax benefit to long-term original investors only. So let's suppose if you acquired sovereign gold bond from off market, now it would be painful to those. By doing so, it aims to curb arbitrage opportunities that arose when investor bought sovereign gold bond on the off market. So it has been now proposed that exemption apply only to the individual who subscribe directly to the sovereign gold bond at the original issue, and they hold continuously at their own name and redeem till maturity across all tranches. So we can say that yes, lower demand in the secondary market may make reduce the liquidity that would make harder to the all sovereign gold bonds before maturity. Yeah. Next slide, please. Yeah. So, it has been industry demand for so many of the years that there are so much of pressure on the taxpayers, also on tax professional as well. So they have heard the requirement of the common taxpayer. So earlier, the non-audit business or partner of the firm whose accounts are not required to be audited, the due date was 31st of July. So if you are the partner, so the due date you have to file in non-audit business cases, partner of firm, the due date was 31st of July. So now they have rationalized this provision. So it is proposed that, okay, this gave that the due date in such cases, if you has been extended till 31st of August. The main point is, if you are a salaried class taxpayer, or if you have capital gain, interest income, the due date remain untouched. For those cases, the due date is still 31st of July. So again, this gives non-audit business and partner adequate time to prepare the books, collate financial and resolve data mismatches, last minute rush, so on and so forth. Since with more time, taxpayers are less likely to miss the deadline and incur late fees, which was earlier as well. So we would say that it is a very welcome move that Honorable Finance Minister has rationalized the provision of extension of due date for certain category of our taxpayers. And yes, again, this would be a compliance as well that they have extended. So again, it was approximately 3 to 4 financial years back. It was 31st of March of the assessment year. So they have stretched down to the 31st of December. And they have again now proposed to, let's say, to file a revised return to 31st of March. So what happens and what happens, and it can be generally be observed if, let's suppose, a corporate SSE and have a transfer pricing has filed the tax return by 30th of November, so they are face very challenges, and it continuously industry, you can say, they have been proposed to the finance minister that they can't revise the return. Let's suppose a short ample of time of 1 month. So again, they heard the ask of the taxpayer, and they have extended the due date, obviously with some nominal fees to the ranging from 1,000 to 5,000, and then they have proposed to 31st of March. Next slide, please. Again, it could be they have rationalized some of the TCS rates, uh, what has been earlier. So they have also rationalized on the LRS remittances on education, medical. Earlier it was the 5% TCS rate. So now they have proposed 2% on education or medical treatment. So again, for frequent international, and they have also, yes, for overseas tour package, if the transaction was either 1 million, so it was 5%, more than 1 million, it was 20%. So they have proposed that, okay, we will keep it as a 2% without threshold. So, all in all, for frequent international traveler, this could translate into lower upfront costs at the time of booking and improve their liquidity. So, yeah, it could improve the liquidity and increase cash in hand for such class of the taxpayer. Next slide, please. Again, they have rationalized some of the fees, or you can say that if you miss that some of the deadlines, they have rationalized they have introduced some capping. If you fail to furnish a statement of financial transaction, earlier it was 500 per day, so they have cut it down to 200 per day with a capping of INR 1 lakh, which is a very good step. So all in all, we can say it is a very good budget for personal tax and corporate tax perspective. With those words, I would like to propose my colleague Manish Kar to speak more on the other aspect.
Thank you, Vikas. Good afternoon, everyone, and good morning to those who are joining us from the different country. So I'll be dealing with the transfer pricing proposals in the budget and all those changes affecting the assessment, reassessment, and overall direct tax litigation procedures. So before we dive into the specific proposals in the budget, it's important to take a step back and understand the broader agenda of the government, particularly when we look at the themes which are emerging out from the last few budget. So over the past few years, the consistent focus of the government has been on the simplification of the tax processes, tax compliances, promoting ease of doing business, and making interaction between taxpayer and tax department more friendly and smoother. So several measures were taken in the last few budgets, like to address the backlog of cases, and to reduce the potential litigation. The changes such as digitization of various tax processes, a reduction in the scope of prosecution, introduction of the block assessment in search and seizure cases, setting up of parallel authority at the CIT level, and so many more changes we have seen in the last few budgets. Even the government data suggests that these measures have worked in the favor of government. Even in the economic survey, the government has highlighted measures that have contributed to widening the tax base. One of the key theme which has been highlighted by the government is the nudge campaign. So it's a very good example, like where the soft communication are sent to taxpayers seeking clarification or highlighting mismatches. This approach has not only improved voluntary compliance but actually contributing to increased tax collection for the government. So, no surprise, this year budget also continues on the same path. The emphasis is clearly on the proposal aimed at simplification and those changes which can potentially reduce disputes and litigation. So the focus is on the certainty. More and more certainty government want to give it to national foreign enterprises which can come to India and do business activities, and obviously, of course, nation is first, so domestic business are also getting benefits by the simplification of the tax system. So starting with the transfer pricing proposals, so in last few years we have seen the announcements from the government, but those announcements were clearly on the papers. Changes were yet to be seen, but this year government has come as a very come with a very blockbuster package for the IT sector, especially to attract the large amount of capital, especially considering the FII exodus that we have seen in the last 6 months. So it was very imperative to keep the confidence and the spirits high for the IT sector, which is considered as a primary contributor to the GCC ecosystem in our country. So safe harbor provisions were already there, but these were not very attractive because the rates prescribed were quite high. There was a various categorization. So IT services have a different segments, different spectrum: contract R&D, IT enabled, IT services, KPO, BPO. So there was a lot of fight, and which used to create kind of uncertainty among the taxpayers. So that is why government has brought in like all these segments which are related to IT, contract R&D, and KPO and IT enabled. They will be clubbed together in a single segment of information technology, and the single safe harbor rate of 15.5% has been prescribed as a safe harbor for them. Earlier there were the different rates depending on the type of services, number of employees, ranging from 17% to 24%. So this is a very significant change, uh, uh, grouping them all together, keeping a single safe harbor for them, and the threshold has been increased from 300 crores to 2000 crore INR 2000 crore. So definitely there will be more takers going forward. This will attract a lot of foreign capital in the country, those who want to come and invest in the IT sector. Especially India is known as a GCC hub, have many offshore units of foreign capital, foreign enterprises. But one of the key change in our opinion, one of the key concern in our opinion is that in India the return on equity is still not keeping up to the 15.5%. So although government has reduced it substantially, but is still for a low risk business with a resource intensive industry but with a limited risk, it is still not sure whether these entities will find it 15.5% very lucrative. So obviously it will depend on case to case basis, but those industries or those companies which are facing litigation in transfer pricing disputes, they can definitely look it as a win-win situation for them. So and the safe harbor application will be without tax examination by the officer. It will be completely automated, and it will be available for 5 years. Earlier safe harbor was limited only 1 year, so you need to file separate application. But now under the new safe harbor rules, for IT sector, you can file the application for the 5 years going forward. So detailed rules are yet to be notified, which after going through the rules, only will be able to strategically, frame what should be the strategy of these companies going forward. And similarly, safe harbor for data center has also been prescribed 15%. Data center has been on the forefront in this budget, because there has been a tax holiday announced for the companies which are into cloud service provider, cloud service business. So this will overall impact the GCCs positively, and we should say, we should look forward to more industries coming forward and opting for the safe harbor. Moving on to the second change, which is in the advanced pricing agreement. So advanced pricing agreement is again a tool to bring certainty in the transfer pricing disputes for MNCs. And AP has actually seen a momentum in the last few years, but it's still the time which used to be there for closing out the APAs. I mean, 5 years is the time, but 4 years it would take just to conclude the APAs. So now the government has actually made the unilateral APA for IT sector time bound, because IT sector has been one of the key beneficiaries. Like, more than, as per the government data, more than 40-50% APAs are alone from the IT sector. So government has introduced a surprise package for them. If you are coming and if you are opting for unilateral APA, we give you a guaranteed period of 2 years for conclusion, which can be extended to 6 months at the behest of a taxpayer. And the second change government has brought in case of APAs is that earlier only the AP applicant used to file a modified return, but now that facility or the benefit has been made available even the foreign related party. For example, in case Indian entity is making payment of royalty or technical fees to its foreign parent. So once a APA is concluded and India his royalty payment or technical fee out payment for Indian entity has been capped. So earlier there was no corresponding benefit available to the foreign AE, because it had already deposited taxes. But now they can actually file a modified return and claim taxes as per the APA conclusion. So this is again a great move by the government to giving more and more certainty to the taxpayers. Can we move on to the next slide? So two more changes in the TP area is relating to TP order timeline. So this is more on a procedure, but this will end the litigation. We will cover it in the litigation slides in a more context, but just to tell you here earlier, so as per the current provision, the time limit for passing the TP order by the transfer pricing officer is a 60 days before the end of due date for passing the order by assessing officer. So how that 60 days would be computed, so that was a debate in itself. So that gave rise to many debates or many litigation, and many of the transfer pricing orders were actually caused because of the interpretation of this 60 days. So now the government has come up with a clarification, like, our intent was always that the day of limitation will not be counted in that 60 days. So for example, for the leap year, now the due date will be 31st January. For non-leap year, it will 30th January, and if the assessment order time limit is 31st December, it will be 1st November. So now this will again put some litigation on rest. Then there is a conversion of Form 3CB penalty in mandatory fee. So there was a penalty for not filing transfer pricing certification Form 3CB of 1 lakh rupee. Now this has been converted into mandatory fee. So if you are filing delayed 3CB, then you need to compulsorily submit a delayed fee. If there is a 1 month delay, up to 1 month delay, there's a 50,000 rupees of mandatory fee, and 1 lakh if in case delay beyond 1 month. Can we move on to next slide, please? So these are the amendments under Black Money Act. If all remember, like, there was a penalty under the black money if you do not disclose your foreign assets and the income in return of income. But government actually removed the penalty for the smaller cases a couple of years back, but prosecution was still there. So now the government has actually removed even the prosecution for those smaller defaults. So if there is any foreign asset, foreign income, whose value is not exceeding 20 lakh, So you can, there will be no more prosecution actually. So this is for giving the relief to the smaller taxpayers, like ESOP holder of foreign companies who are the resident of India, but they have got ESOP from the foreign companies, or the students who have gone to outside India for studies and they have their bank account and have low balance bank accounts. So all these cases will be covered there. Then the second change in the black money is the amnesty scheme. So government will be introducing the 6 months compliance window where the people can actually go and disclose their assets which were which were earlier undisclosed. So there are the two categories government has created. If you have undisclosed assets or undisclosed income, which is up to INR 1 crore, you can simply go away with the 30% tax and 30% penalty. I mean, penalty 100%, but that is on the tax portion. So basically, in terms of taxes, so there's a 60% total outlay that the person has to pay, and he can walk free. But this is for the small cases where the asset and the income value is not exceeding 1 crore as at 31st March 2026. And the second category is for the taxpayers who have actually purchased some foreign assets. For example, you invested in some foreign company shares or maintain some bank account there, but that was from the tax paid money. But you just fail to disclose that, because many people unintentionally fail to disclose that because they're not aware about the tax rules. So if the value of those assets which has been undisclosed is less than 5 crore, then they can simply walk away with paying a 1 lakh rupees as a fee. So I think this is again a welcome move and will encourage people to come forward and voluntarily disclose the things. Can we go to the next slide? Okay, so now these are the interesting amendments. These are actually the retrospective amendments. So I'll be covering all four amendments individually, very briefly, and then putting all them in the single context. So first amendment is relating to section 144C and section 153 timelines interplay. So so whenever there is a case of transfer pricing and non-residents, so they get option to file an appeal before the DRP, dispute resolution panel. So when you file an appeal with the DRP, you get extra 9 months. DRP gets 9 months to pass an order. So accordingly, the time limit for assessment is increased. Now, how the law is worded, there has always been an ambiguity whether the 9 months DRP time limit is included in the overall time limit which has been prescribed in the section 153. I mean, whether this 9 month is extra of the assessment timeline or it is included in the timeline. So there was a complete deadlock in the judiciary over this issue, and there were the many, high courts have given a judgment in the favor of Roka bathroom and shelf drillings. That's how this controversy is popularly known by the name of Roka bathroom and shelf drilling. The matter ultimately reached to Supreme Court. So now this is pending for the adjudication because the Supreme Court again decided the matter and there was a split verdict. But due to the split verdict, this matter was again referred to the larger bench, and this is pending for adjudication. Now, during the pendency of that final decision by the Supreme Court, government has actually brought in a retrospective amendment that our objective was always that this 9 months timeline is extra to those timeline which has been prescribed in section 153. So I mean this we will cover this in the next slide, and moving on to the second retrospective amendment, which is on the DIN issue. So the government brought in a circular few years back saying uh, the tax officer will require to post digital identification number on the notices and orders, whatever communication they are issuing to the taxpayers, so that they cannot issue the notices order in the back date, because there were some practices going on in the tax department. To safeguard this, to prevent this practice, they brought in the concept of DIN, that a tax officer need to mention the DIN compulsorily on the orders. But still there were some practices going on that DIN was not properly mentioned. There were some digits, I mean all digits were not mentioned. Sometime DIN was not mentioned at all, but next day separate letter is issued in addition to the order and notice that just for the purpose of din. So all this led to controversies and the matter ultimately reached to court, and some of the assessment have been quashed on this issue. So now government has brought in a retrospective amendment that if there are the mechanical irregularities over the din mentioning, incorrect din or something, mistake or defect or omission, this will not be considered. I mean, this should not lead to the quashing of the assessment. This, I mean, then the assessment order will be considered valid. So they have, in a way, validated the procedural defects that the tax officer were committing. So they have given a condition that there should be just mere reference of din in any manner will be will be sufficient. Moving on to the third change, can we move on to the next slide? So these are the two retrospective amendment out of the four which we'll be talking about. Third is on the TPO order, which we talked about briefly, that there was a 60 days timeline for passing the TPO order. There was a controversy on how this 60 days should be computed. So again, there was, controversy and interpretational issues in the judiciary, and cases were pending at various levels. So government brought in the amendment, okay, how these 60 days will be computed. Now, the fourth issue we popularly known as Jao versus Fao, jurisdictional assessing officer and faceless assessing officer. So, this controversy is about the reassessment procedures. I mean, when in 2021 reassessment regime was revamped, so there was a mandatory inquiry which assessing officer need to do before reopening your case. So, how the law was worded, there was a interpretational differences. How the law was worded, it was clearly that all the, I mean, the pre-reassessment inquiry and the post-reassessment inquiry proceeding will be carried out faceless officers only. But in many cases, before going on to the reassessment, reassessment inquiry was carried out by the physical jurisdictional assessing officer. So these matter again reached to high courts. So there were the divergent views from two high courts. That is why Supreme Court took cognizance of the matter, and this is actually pending for adjudication in the Supreme Court. So similar to the DRP case interplay with the timeline, this again pending for adjudication in the Supreme Court. Now, all these four issues differ in nature, but the single theme which is actually putting them in a single context, the single thread is that the government aimed to putting litigation on rest and to cover up for the procedural defects which the tax officers had made. And potentially, actually, the government is trying to safeguard the revenue which might be running in the thousands of the crores if they would have, lost all these cases. So now a lot of questions are arising. Okay, by this retrospective amendment, definitely the litigation will reduce, but somehow this will also cover up for the procedural mistakes that the tax officers are doing on a day in day out. So even in the two cases which I told, these are pending at the Supreme Court level. Now at Supreme Court, government is itself one of the parties in the case. Now one party is bringing the retrospective amendment. Can this be considered as contempt of the court, because they did not wait for the Supreme Court to pass a decision and they came up with the retrospective amendment? So definitely this is again going to start a fresh wave of litigation. But as of now, government is in the winning side and they are advertising this as a reduction of litigation measure. So can we move on to the next slide? Okay, so other amendment related to assessment and reassessment is so updated return can be filed now in the reassessment. Earlier, the updated return can only be filed before assessment or reassessment, but now government wants to encourage people to come forward. Even there is a reassessment, you can file updated return to disclose that income, and in a way you can just pay the tax, and you can save the penalties. So second change is the rationalization of tax rate. So this was a special tax rate of 60% for unexplained credit, unexplained investment asset was brought in at the time of demonetization, because a lot of cash and a lot of money was discovered which was actually not tax paid at that time. So so there was a special tax rate of 60% to tax those additions to bring those issues at par with the normal tax issues. Government has actually brought down the tax rate from 60% to 30%, and there was a special penalty of 10%, which has been omitted, which has been removed, and now these cases will be falling into the same category of a normal cases. Like they attract penalty of 200% for the misreporting, so they will also attract penalty of 200% these cases. Then the third change is in the reduction of pre-deposit limit. This is a welcome move definitely, because a lot of representations were sent since years to the government. Like at this stage, under the existing provision, there is a mandatory requirement of submitting the 20% deposit to the government if assessee wants to file an appeal, want to go and fight its case. But 20% used to be the considerable amount, and especially in the case of individual assessees, liquidity was always a issue. But now the government has reduced that requirement from 20% to 10%. Again, this is just a part of budget announcement. Detailed rules will be announced in the due course. But 20 to 10% will definitely bring down the liquidity issue on the some taxpayers who want to go and fight in appeals. Can we move on to next slide? So these two amendments are in the block assessment. Earlier block assessment, in the case of block assessment, the time limit for completing the assessment was 12 months from the end of the quarter in which the authorization for search was issued. Now this has been increased to 18 months. And the government has cited the reason that earlier the searches are mostly carried out for the group of people. So that is why to allow the administrative convenience for the tax officer, 12 months time limit has been increased to 18 months. And the second change is with respect to restricting the scope of search and seizure assessment in case of third person. For example, when a search is carried out, lot of incriminating material is found which actually pertains to the third person. So earlier, maybe that information only pertains to particular financial year for that third person, but the assessment used to be done for block period of 6 years for him as well. But now government has said that in case the material pertains to particular year, that assessment in case of third person will only be limited to that particular year. So this will reduce the exposure for the third person in who has been unintentionally the subject of the search and seizure. Can we move on to next slide? Yeah, so these are important changes. Actually, the rationalization of penalties mechanism. So earlier, there were the two kind of penalties when assessment used to happen: 50% if there is underreporting, and 200% for the misreporting. Misreporting is for the grave offenses. Where unintentional, or sorry, the malified intentions are found by the tax officers. So earlier, for the 50% penalty, immunity was available. You just submit tax, you don't file appeal, and the case will be closed right there. But for 200%, there was no immunity. Now the government has said, okay, we want you to close the case, we want to reduce the backlog in the appeal. So okay, come, don't submit 200%, you just submit 100% penalty. They are calling it a fees, additional tax, and the case will be closed right there. So in a way, immunity now will be available in case of misreporting penalty as well. The second is integration of penalty order and assessment order. Whenever assessment happens, penalty proceedings are initiated right at that time. So there are the two legs of proceedings happen. Different orders are passed, and accordingly, assessee has to file two appeals, although connected to the single matter. For the administrative convenience of the tax officers as well as taxpayer, now the assessment order and penalty order will be merged. Means assessee can file a single appeal against assessment order, and interest on that penalty will only be computed once the appeal is decided at the first appellate level. So this is a great change to bring down the administrative challenge on the taxpayer as well as tax officers. Can we move to the next slide? Okay, so decriminalization of the tax offenses. So this has been a theme in the past few budgets as well. Going into the background, Niti Aayog, set up a committee and issued a report in November 2025 for the trust-based governance. So there are currently 35 offenses in the Income Tax Act which actually attract the penalty. So Niti Aayog suggested that out of 35 only 6 or 7 category of offenses are there which are actually for the grave offenses and which can actually should carry the prosecution. Rest of the offenses should be done away only by a civil or the monetary penalty on the assessees. So or keeping the Niti Aayog report as a base, government has actually reduced the prosecution to a very limited number of offenses which are actually grave in nature. Or even in the prosecution, they have reduced the seriousness of the prosecution. For example, rigorous imprisonment has been replaced with simple imprisonment in most of the offenses. Maximum imprisonment of 7 years, which used to be earlier, now has been reduced to 2 years. There is no prosecution for small or technical or the low value defaults. Only monetary penalty will be applicable. High monetary threshold has been introduced to provide relief to the taxpayer for being more compliant, and criminal action will be limited to only cases where the malified intent or the repeated non-compliance is found. So this is, I mean, all in all these changes are reflecting or demonstrating the government's agenda to give confidence to the taxpayer, encourage them to come forward and voluntarily disclose the things. With that, I would like to pass over the stage to my colleague Ikesh Nagpal, who will be deliberating on the indirect tax proposals in the budget. Thank you so much.
So, very good evening to all of you. So, now we'll be discussing the indirect taxes. So, let's start with GST. So in GST, one of the most important change which is brought is that the place of supply for intermediary services have been changed from the location of supplier to the location of recipient. This is a very important change which is brought in place. So it helps the uh, domestic players who are providing the services to foreign clients of the intermediary services which were taxed in India will now be taxed as exports, which will be considered as exports because in exports there is a primary condition that is the place of supply should fall outside India, and in this case the place of supply was falling within India, and it was not a destination based tax. So now this amendment has brought in place which will rectify the situation, and it will be a destination based tax, and accordingly they will be able to consider this transaction as exports and claim the benefit of zero rated. It is also beneficial for other export of services taxpayers because lot of services were considered or litigative around the intermediary services like business support service, marketing service, advertising service, or any tri-party arrangement is there. So these were litigative surrounding the intermediary services, which the department were issuing notices to a lot of the taxpayers with respect to intermediary services and were considered as domestic, or the litigations were going around to that area. So now these will be taxed as the basically as exports, and this will help the taxpayers to for filing the refunds, and the litigation will be sorted from the prospective area. But it is not a retrospective amendment, it is a prospective amendment. In similarly, one of the most important thing which we need to know is that in cases of intermediary, if there is the import of transactions, in that case also the import of transactions are basically having three criteria: that a supplier is located outside India, the recipient is located in India, and the place of supply should fall in India. So if any supplier was sitting outside India and providing a service from outside India to a recipient earlier, it was not considered as import of service because the place of supply was falling outside India. But now it is falling within India, so it will be considered as import of service, and RCM shall also be applicable. So if we are availing any intermediary service from outside India, so that is also we need to keep that in mind. But this is a very positive move for all the export of services, not just intermediary service, because the litigations will be reduced up to a very large extent, in my opinion. So now let's move to the second point, that is the post-sale discount. So in post-sale discount, there were basically three conditions which we need to comply with. That is that prior sale agreement must be there, invoice linking must also be there, and the ITC must be reversed by the recipient. Now, two of the conditions which were there, that is the prior sale agreement and the invoice level uh, linkages are done away with. So it will help lot of taxpayers who are doing the post-sale discounts to or the volume discounts in transactions. So they can help with this. This amendment will help basically these taxpayers. And a circular was basically issued with, that was the 212 circular was there, which basically says that the taxpayer who is the recipient has to give a self declaration if the transaction is below 5 lakh for the reversal of ITC, and if the transaction is above 5 lakh, in that cases a CA certificate was required to be issued for the reversal of ITC. And with the invoice management system brought in place, now this circular have been withdrawn, and with this new conditions, now 251 circular have been new issued, with this, which is aligning basically with these amendments as well. So if any financial or commercial credit note is issued, in that case ITC is not required to be reduced. But in other cases, when the invoice level management system is there, it basically ensures that ITC is reversed, and now there is no prior sale agreement is required, or invoice level linkages is also required. So basically the value of transactions can be reduced easily, and the credit reversal is automatically reflected when you and managed by the invoice level management system. So accordingly, post sale discounts will help those taxpayers. So now bringing to the next change, that is with respect to refunds. Now the provisional refunds of 90%, which was earlier there in cases of exports, is also brought in place for the inverted duty rate structures. With GST 2.0, lot of taxpayers where the rate rationalization happened, the inverted duty structures were brought in place in these taxpayers in taxpayers transactions as well. So now if the taxpayer is into the inverted duty rate structure, they can not only get the refund but also get the provisional refund up to 90%. However, in our opinion, that 90% of provisional refunds are very less issued in cases of exports as well. So with risk-based assessment and identification of the uh, taxpayers, faulty taxpayers, which is government is trying to introduce, I hope that this 90% of provisional refund is must be issued to the inverted duty rate structure and to also to the export transactions as well. So with the next change in refund is basically that minimum threshold limit of 1,000 rupees was removed from the exports of with payment of tax. Earlier, in cases of with payment or any other refunds, there was a threshold of minimum 1,000 rupees where you cannot apply for refund if the threshold limit is less than, if the refund amount is less than 1,000 rupees. So in cases of exports of goods with payment, this threshold has been removed because there are many small value invoices or low value consignments, but the transactions are in huge volumes and they were not getting the refunds. So now this condition have been removed, and accordingly they are able to claim the refund. This amendment is very welcoming for the taxpayers. So now we can move to the customs changes. Gaurav, can you move to the next slide, please? So a very important change in custom is that the validity of the advance rulings have been extended. So earlier, if you have applied for any advance ruling, if there is, it shall be applicable only for 3 years, until unless if there is a change in law or fact, it is valid only for 3 years. Else you have to apply again for the advance ruling. So now this advance ruling period have been changed from 3 years to 5 years. So basically, uh, it is helping the taxpayers to apply less, and they can this validity period will help the taxpayers for their continuity, and it will not extend it to that again and again they have to file for the advance rulings in the frequent times. So this is a very business friendly move in cases where they have already applied for an advance ruling. So in that cases also, they can just give an application for the extension, and they can this advance ruling, which was applicable up to 3 years, will be extended up to 5 years from the original date of ruling. So this is also a very welcome move. This will help the taxpayers in reducing again application reappeal applications, and improve the ease of doing business for the tax positions, and bring the certainty to the tax environment. So the next change is in relaxing of the warehouse goods, where there is a removal from one warehouse to another. So whenever the goods are being imported, if you are keeping the goods in bonded warehouse, so you can it helps the basically taxpayers from keeping into bonded warehouse and import whenever they want. So earlier, if you are moving the goods from one warehouse to another warehouse, you were required to take up permissions. Lot of paperwork was also required, lot of documentation were required to be submitted, that whether the goods are having the place in the existing warehouse where the goods are moving. Another approvals are required from the proper officer, and the warehouse location is also required, that where the goods are moving, whether the proper space is appropriated or not. So accordingly, lot of documentations and permissions were required. So now this will be simplified. The self-declaration mechanism through digital system will be brought in place, and accordingly, without any, we do not need to take any permission from the proper officer. You just need to do the self-declaration, submit the proper documents, and you can move the goods from one warehouse to another warehouse without any approval. So it will help faster operations, lower the cost, and improves supply chain efficiencies, and accordingly the business will also improve, that it will help less of the documents accordingly. So now, the last important change in customs which is there is for the personal use, that if you are importing any goods for a personal use, earlier the duty was 20%, now it have been reduced to 10%. So it is a very welcome move, that if you are importing any goods for your own personal use, that the goods shall be duty shall be removed from 20% to 10%. So now we have completed with the budget session. If you have any queries, you may please enter the queries in your Q&A, uh, and we can also enable chat if it is required.
I believe few attendees have some of the questions. Likewise, Mahek asking, what are your views on the increased STT rate on FNO? Sandeep, sir, could you answer, please?
I think Ikesh would be the best person to answer it.
Okay. Yeah. Ikesh, can you answer?
My
Yeah.
view on STT on FNO is that it is basically introduced in FNO to reduce the small retailers who are involved in FNO. So the participation of FNO shall be reduced for the small taxpayers. But in my view, it won't reduce for the retail taxpayers, and it is increasing the cost for the big players who are involved in FNO. So that is why we see a strong movement in basically stock market at that point of time, because the small retailers who are involved in FNO and small tax payers who are involved in FNO, I think that STT don't affect them, because they already are incurring a lot of losses, and this will only increase their losses. But if the habit is reduced, that would be a very positive move from the government side. This is my take on this STT rate on FNO.
Great. And someone is also asking, can you please elaborate with the help of any example more on receipt of intermediary service by Indian recipient? Is there any indication that the authorities may ask for tax under RCM on intermediary services received by Indian recipient prior to this amendment? Ikesh. This is for you.
Yeah, just let me see the question.
Hmm.
Can you please elaborate with the help? Let me repeat the question. Can you please elaborate with the help of any example more on receipt of intermediary service by Indian recipient? Is there any indication that authorities may ask for tax on under RSM on intermediary service received by Indian receiver prior to this amendment? Okay, so prior to this amendment, the department may always ask, but in cases of import of service, there are three basic conditions which you can always defend. That is that supplier is located outside India, the recipient is located in India, and the place of supply should fall in India. So any intermediary service. So let's say, let me give an example. Let's say I want to develop a business. I want to get a sales in USA. Okay, I want to sell my carpets in USA. So I connected with an agent who is helping me to sales in the my carpets in USA. So he takes his commission and he provides me a service. So earlier, if any service was provided in such a way that he helped me selling the carpet, so in that cases, and he takes the commission on his sales, and so accordingly, in at that point of time, if this service is like an intermediary service, considering the arrangements as well, so at that point of time, I do not require to pay any RCM, even if he's providing a service to me. Okay, but in cases with this recent amendment, now I am required to pay RCM on these services. Prior to this, you can always defend your case that the place of supply is not there. So accordingly, you can always defend that case.
Great. Someone is asking, Yash, why was the ICI suggestion on joint ITR was not included in the new Finance Act? What are your views on the same? Sandisa, would you like to take this up?
Yeah, so I think this question is something which require great, I mean, further deliverance on the part of the authorities. So I think maybe they have the view that the time for this hasn't come. I mean, as of now, I mean, if you see, I mean, this utility is something which is available even as of now for limited purpose for some Goa residents who are into this Portuguese tax regime or something. But I think what has happened is that maybe the authorities don't feel that this is something which is asked for, or there is, I mean, they don't feel that there is a clamor for this from the ordinary people as such. Maybe in some circle, the professionals are asking for it, but maybe the authorities are not convinced of the need for it as of now. So I think this is something which will take some time.
Someone is asking, what are the difference between the erstwhile LDC obtaining procedure and the one proposed in the new finance bill? So let me honestly tell you, for the small taxpayers needs to sometime oftenly visit to the tax authorities to obtain the LDC, be it lower rate or be it nil rate. So by introduction of such provision, we could say that yes, government is on the right path to rationalize the provisions for the ease of small taxpayers. So yeah, so so in the budget, so small taxpayers can file the application by electronic verification, probably the EBC code from the EBC. So let's see what would be written in the tax rules. And Ikesh, someone is asking, do we continue to have the option to issue commercial credit notes where discount are provided after the sale?
So, yes, the option of issuing a commercial and credit note or financial credit note is always there wherever a discount is provided. But in that cases, the value of sales shall not be reduced. So it depends on the total transaction because the post-sale transaction must have the total agreements. However, in cases where there is a linkage, like a manufacturer is giving a distributor a post-sale discount in a way that the ultimate consumer will be given a discount and then I will give you, the manufacturer will give the discount to the distributor, that will still be there. In that cases, the benefit of the value reduction and the credit note and the ITC reduction shall be there. But in cases of commercial note, there is no bar on issuing the credit note or financial credit note. but the ITC reduction shall not be there. The taxes shall also not be reduced if because the ITC of the recipient is not reduced. There is another question. Let me take that up, Vikas. There are certain changes with respect to conducting of fishing activities beyond the territorial water in custom laws. Can you please? The changes basically is there wherever the marine industry players, wherever the fisher is basically going. These are basically for small taxpayers or marine industry. You may say that basically if they are moving their fish into the ocean, they are not able to see the actual boundaries, because in the water there is no boundary. They do not know that whether they have crossed the boundary or not. So when they are going beyond territorial waters and exclusive economic zone of India, if they are carrying a flag of India and bringing it back to India, in that cases earlier, as per the definitions, it was considered as import, because goods moving from outside India to a place in India, it shall be considered as import. So now this will be considered within the territory, and it will help the taxpayers because they do not have to pay the duty, and it will help a lot of taxpayers. So I hope I have answered your question. If you have any doubt regarding the same, you may please uh, uh, enter it over here.
Any more questions from the participants, since we are running short of time?
Yeah, so because I think we've already exceeded time, so I think we have answered all the questions which have been
Sure,
posted
sir.
on the Q&A section. So thank you very much for patient listening. But let's say if there are still any further questions, you can definitely write to us. Email ID, you can find it from the website, or it is also available on the screen as you can see. So after this, we would like to conclude this session, and thank you very much for all my colleagues for this beautiful session, and I would like to thank the audience here. Yeah, we've just I mean before the end, I mean, in case there is another question related to indirect tax proposals, how do you anticipate the
Amid the
so what do
global
you
disruptions and tariff tensions, how to anticipate indirect proposal are going to contribute as a relief? Okay, so basically the government of India is trying to make a deal with each and every country that where we can bring a lot of value of business to India, and wherever we can bring the GDP increase, like the raw materials for semiconductor or rare earth materials duty we can import, and we can bring some value to them as well where they require some goods. So that is why that is how the basically the trade deals are being happening. However, some of the deals which you may agree or may not agree, like in US trade deal, some of the opinions are that it is not in our favor, and it is in the favor of US. Some industries may get the benefit, like the IT industry and the pharma industry may get the benefit of it, but the agriculture may get the harmful effects of that growth. So this is a very open end question that which I may continue for a longer time, but due to certainty of time, so paucity of time, I'm just restricting to that.
yeah. And the thing is, I mean, there is still a lot of information which is not available on this trade deal as of now. I mean, we don't have any kind of fine print where we can look
Yeah,
at
I
it, what
agree. I
exactly
agree.
has been discussed. So I think it is too early to comment anything as of now on this. Yeah. So, case there is another question which relates to the baggage rules. Maybe if you can explain.
Baggage rules have been revised with custom duty reducing. So basically, if there is any baggage rules have been revised with custom duty on reduced on personal items, if any penalties was introduced, so in that perspective, so now they can pay instead of penalties, they can pay the additional duties. Lot of easement of within the definitions have also been brought in place. The value of the import is also increased for the foreign taxpayers and for the domestic taxpayers, so that they can get a relief, and the honest taxpayers who are basically bringing some goods or by mistake in some of the excess quantity, they can just pay the duty and not to pay the penalties and everything in hefty amounts. And we have seen a lot of cases like where the jewelry and the other products for personal use have been uh, withheld by the custom authorities. Now the high courts and supreme court and the rules along with the government is bringing that basically that these taxpayers should not be, because these are not taxpayers, because these are the honest travelers for personal consumptions, which should not be for taken harmful steps against the same, but only the duties should be paid. So they are taking that view, and it is a very welcome move, I believe, for these taxpayers.
Then because there's another question, the last. No.
There have been a recent overhaul in indirect taxes. How the changes have impacted the government revenue? Is there any negative impact of such rates? No, I think that it is a very positive move for the. Let me repeat the question for all the audience, that there have been a recent change overall in indirect taxes recently. How the changes have impacted the government revenue? Is there any negative impact of such rates overall from the growth perspective? So it is a very welcome move from the government perspective, that they have reduced the rate and the consumption have increased. And accordingly, when the consumption have increased, so the net revenue now, if you will see the data of the October month and the January month, it is the same. So it was reduced, the taxes collection were reduced in November and December, and now again the consumption have picked up, and again the consumption is now similar to the October month revenue. And the highest was in April, I guess, April or May, I guess. And I am very sure that the consumption will go to up to that, because whenever the rate is reduced, the consumption increase and it matches the revenue of the government. So I think that it is very welcome move for the taxpayers and for the government as well.
Yeah. So with this, I think we have concluded all the questions. So let's just wrap it up. Thank you very much for your patient listening. And as I said, I mean, you can write to us separately over email if there are any further questions. So thank you so much. Thank you.
Thank you, everyone.
Thank you everyone.
Thank you.
Thank you
Thank you. Bye.
everyone.
Bye.
Bye.